Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. And you often hear me talk about the fact that it's a market of stocks rather than a stock market. And there's actually a lot of different meanings to that. In the last video I did, I talked about dividend growth stocks to beat the market. In other words, it was kind of a total return orientation of the companies I covered in that video. Well, in today's video, I'm going to focus on 20 dividend stocks for current income. And the key idea here is that, stocks are different in a lot of ways. Some grow faster than others. Some pay dividends. Some don't pay dividends. Some have higher dividend yields than others. And usually when you have a higher dividend yield, you give up dividend growth, or at least a portion of dividend growth. And there's almost everything in between there. So what I'm focusing on here now would be dividend stocks for people that need current income. Let's say you're retired, you're living off your income, you don't feel like you can get enough money out of a bond or a bond fund, so you're looking to dividend stocks to give you the income. So what I've done is I've put together 20 stocks here that have dividend yields of 4% or better, and these are generally very, very high quality companies. And what I'm going to do is I'm going to go through them by sector. Okay, we're looking at each of the ones in the different sectors. And the point I want to make before I get into that is you can build a portfolio totally out of the names that I'm showing you here, where your focus is on getting the maximum current income you can, or you can mix and match these with some of the lower yielding, faster growing stocks that I mentioned in the previous video. And that's really the whole point here. You want to build a portfolio that meets your own unique goals and objectives. And so, by understanding the different types of stocks, the different categories they're in, the different amounts of income they can produce on your behalf, and even the different amount of growth of income. Because even with a high income portfolio, I continue to believe that you do deserve a raise in pay, and you want to be able to build a portfolio that gives you an increasing income stream so you can fight inflation. So I'm going to look at primarily higher yielding stocks in this video today. So let's go ahead and get started and look at it from a standpoint of the portfolio review. I'm going to be covering 2 utility stocks, 4 REITs or real estate stocks, 1 in information technology, 1 in healthcare, 2 financials, 4 in energy, and then I've got 3 in consumer staples and then 2 in communication services. By the way, when I cover AT&T and Verizon, these were actually a subscriber request to cover those. So I'll be fulfilling that obligation, if you will, in this particular video. But let's start by looking at the 2 utility stocks. I'm going to look at South Jersey Industries here. Now, I want to make a couple of points about utility stocks. They tend to be slower growing stocks than you'll find with your traditional, dividend paying stocks like your 3Ms and your Nikes and your Philip Morris's or even your McDonald's and so on. South Jersey Industries actually is one of the faster growing utilities you'll see, but it's also somewhat erratic. I want you to notice that earnings starting in 2011 went through a period of time where they actually fell in succession for several years in a row, and then they rallied over 50% for 2020, and now they're expected to grow at, basically flatline in 2021, then grow by 3 to 5% going forward. So if I look at South Jersey going forward, the analysts are expecting about 3.6% growth. And there are 5 analysts going out to 2023, but there are 10 analysts for 2021 and 2022. So the bottom line is this is going to be a classic slow growth utility. What's attractive about it is it was very highly valued, as you can see here on the graph, over the last 2 or 3 years. And then we had this correction where the price had fallen significantly. It fell from up here in the 30s, even as high, I think the high was 38 here in 2017, and now it's trading at 22.25. The blended PE is 13.2, and that gives me an earnings yield of 7.56. But most importantly, since my focus is on current income, it gives me a 5.44% current dividend yield. So that, is a yield that's significantly higher than what you can get off of the market. That's significantly higher than you can get in most fixed income. Now, when I look at long-term performance on this company, just to give you a perspective, capital appreciation has been pretty much aligned with the annual rate of earnings growth, 5.6% capital appreciation. But notice the income advantage here. If you'd invested in the S&P 500 or an index and put the same $10,000 in the beginning of 2000, you'd have received almost double your money by owning this high-quality South Jersey utility stock, versus only earning $4,000, just call it $4,500 in the S&P. Now, from a capital appreciation point of view, interestingly enough, you ended up in a dead heat for this long-term time frame here. But again, I want you to notice that earnings growth of 5.43% correlated very closely to the actual capital appreciation that the stock performed, because notice that you had starting valuation here was pretty much in line with what you currently have. So therefore, you've participated fully in the growth of the company. Now, the dividend record here has been quite good. It's not, the fastest growing stock you ever see, but the dividend growth has averaged 6.4% or a compound average growth of 6.3%. Now, you can notice that you'll see that, change. There'll be times where they had double-digit dividend growth, and then more recently, as earnings have, faltered a little bit, as I showed you earlier, we're starting to see dividend growth has only averaged 2.5% or 3%. So that's something else that you want to be able to focus on. The dividend growth rate for this company has actually been slowing down in recent times, and I would expect it to be, more in alignment with what its growth would look like going forward. So, there you have it. There's South Jersey Industries. It's BBB rated, has about 53% debt, and it's a real good quality utility that's fairly valued. Utility stocks, by the way, my favorite utility stocks are actually overvalued today. And this is a case of one that was overvalued but has now come into fair value territory. The next one I'm going to look at is another electric utility, OGE Energy. I've covered this one before. Again, we have an example of a utility stock that was highly overvalued. Notice that COVID brought it down into attractive valuation. This company is moderately cyclical. Average earnings growth has been about 4%. It yields 4.97% currently, and it's BBB plus rated with only 48% debt. So it's a good, solid utility. When I look at the long-term dividend record, I want you to take note of the fact that from 2001 all the way through 2005, this company froze its dividend. It didn't grow the dividend. Then starting in 2006, it began growing the dividend ever so slightly. Now, more recently, it's actually given us double-digit dividend growth. And again, you can look at a statistic like the average growth was 4.7%, but to really understand that growth, you need to look at the detail as I'm showing you here on this long-term dividend growth table that you see. A $10,000 investment would have thrown off just under $15,000 in total income, compared to, again, that 45-ish hundred in the S&P. Capital appreciation was close to the S&P, but slightly below. But when you add the dividend income plus capital appreciation, this utility stock would have outperformed the market. It's trading right at the cusp. It's got a 6.47% earnings yield. As you know, I like 6.5 or even 7% or better, but this one is a good, solid utility with a fair valuation and a dividend yield of just touching 5% based on the close on March 26th. So next, I'm going to go ahead and go into some REITs for you, some real estate investment trusts. I'm going to start with Omega Healthcare Investors. What I want to point out before I go on, when you look at REITs, you want to look at funds from operations. That's really the metric. The reason for that is REITs tend to do a lot of capital raising. They issue new shares constantly, and they're always, adding new product lines to their company. So earnings tend to be very, very spotty, but funds from operations really kind of represents their distributable income, and it's one of the unique characteristics of REITs. So when you're looking at REITs, you go to operating cash flow if you're a Fast Graph subscriber, and we automatically convert that to FFO, which is funds from operations. There's a second metric for REITs, which would be free cash flow with a C Corp, and it's called adjusted funds from operations. Now, this is a newer metric that's only been, available on REITs for about the last 8 or 10 years. So you tend to get less data here, but there are those that believe this is a more conservative way to look at REITs. But I like to look at them with both AFFO and FFO. Anyway, with Omega, you can see on its price to AFFO, it's trading at under 12 times AFFO. That gives it an AFFO yield of 8.36%, which is above that 6 or 7% kind of minimum number that I personally prefer. We've got a very attractive dividend yield here of 7%. Now, I want to just take a pause here for a moment. So you can combine this with like a 3% yielding company, like some of the ones I talked about in the last video. And the combination of blending it with a 3%er would give you a 10% average yield. based on a combination of the two companies. And that's how you can also, beef up your income, but also maintain the opportunity to see some growth or capital appreciation. The long-term performance going back here to 2006, I'm using a different time frame. A $10,000 investment would have thrown off 5 times as much income approximately as what you'd have got in the S&P 500. Capital appreciation was a little bit subpar, but it was consistent with the company's AFFO growth. Bottom line is the combination of income plus capital appreciation, you would have outperformed the market. And I want to make a point about this because here I'm focused more on income, but just because you're focused on income doesn't mean you're giving up all potential capital appreciation. The forecast AFFO growth in this case that you're looking at here by 10 analysts and 9 analysts over the next couple of years is small, only 1% or 3%, but because it's trading at a discount to what I would call fair value, which I'm using a multiple here of 13.8, I do want you to see that. I would even put a higher multiple. If I go to the normal multiple here, it's even been lowered 11.7. But the point I'm making is that if this stock does grow the FFO, I can average over 17% a year for the next couple of years. Next year and, we'll call it 3 quarters or so. And even if I go out further, if I'm willing to go out further, I'm still making double-digit rates of return. So just because you're buying a high-yield stock doesn't mean you're giving up capital appreciation. These companies just tend to grow slower than some of your faster growing dividend kings or dividend aristocrats, where you can get 6, 7, 8, 9, sometimes even 10 or 12% growth, as I showed in the last video. But again, if you combine this with a 3% yielder, you can be averaging over 5%. The next REIT I want to show is another healthcare REIT, National Health Investors. It's got a very consistent historical record. Growth rate's only been about 3.8%. As far as FFO growth, I'm back now to funds from operations here. I want you to notice it was very undervalued at the start here. And so even though I only had 3.8% FFO growth, if I look at long-term performance, I ended up getting 12%. This gives me opportunity to talk to you a little bit about valuation. Valuation matters, and it matters a lot. By being able to buy this company so inexpensively back there in the beginning of 2001, you'd have actually turned a 4% grower into a 12% rate of return. Look at the dividend income. 10,000 would have generated almost 71,000 in income. You'd have got 7 times your investment back in dividend income alone, and your 10,000 would be worth 103,000, averaging over a 15% rate of return. Now, the one difference here, we have undervaluation again today, but we don't have the undervaluation we had back in the beginning here, which was during the recession of 2001, just to be clear about that. However, if I'm looking at this stock from a standpoint of what its potential is, earnings growth is expected to be under 2%. So therefore, if I'm looking at this from a standpoint of what the growth potential is, I don't see a lot of growth here. The long-term growth is expected to be about 4%. So this is really, in this case, we're looking at all about yield, more so than we are about capital appreciation or making a lot of money. It's BBB minus rated, only has 34% debt to capital. I consider this an excellent choice if you're looking for almost a 6% current yield. The next REIT I'm going to look at is another healthcare REIT, Medical Properties. You're seeing a common theme here, by the way. If you look at the overall market right now, you're going to see a lot of healthcare-oriented businesses, including REITs, as well as financial companies if you're looking at regular corporations that are undervalued. And there's reasons for that, which I won't get into in this video. Nevertheless, if I look at Medical Properties here, I want you to see that the company's traded, its earnings have followed its funds from operations. If I look at long-term performance of the company, it generated an awful lot of dividend income. Generally, REITs are all about investing for dividends. So again, this is another example where you're looking for yield. It underperformed the market in capital appreciation over this time frame, which here I'm looking at July of 05 through yesterday's closing price. And the reason for that is because that's when this company went public. That's what I'm showing you now. If I shorten this time frame and get past the Great Recession and look at it where it was reasonably valued, for example, in 2012, and then check performance, this was a very good period for the market, but I still beat it dramatically on terms of total income. And that's what REITs are all about. How much income. I still would have more than doubled my money. I'd have averaged about a 12.6% rate of return, compared to 14.4 in the S&P, but I got an enormous amount of income. I'm going to repeat, if I was retired and living off my income, this REIT would fill the bill, and it's a 5.25% current dividend yield, blended FFO yield of 7.5, blended price to FFO of 13.3. This one's only BB plus rated, which, by the way, is a pretty good rating for REITs. I don't think there is a REIT that's into the A-rated category, maybe one or two, but not many. Company has 53% debt. The next one I'm going to look at is Iron Mountain. It's a specialized REIT. It's basically involved in data storage and so on, which obviously we know is hot. As you can see, the company has a relatively spotty record. They only started paying a dividend in 2010. So I'm going to shorten this time frame here dramatically. Actually, I've shortened it a little too much there. Let me shorten it again to just where they started paying a dividend. If I look at their performance, FFO performance was actually very poor, but it started to improve, and it's expected to improve dramatically. So when I'm looking at long-term performance here, I don't have much in the capital appreciation aspect, but I do have more than double the income from the S&P over this shortened time frame going back from 2009 to current. I think the key point here is to look at it from a forecasting point of view. This specialized REIT is expected to grow at 8.44% going forward. And by the way, I talk about this a lot, and I want to reiterate it here. I can learn from the past, but I can only invest in the future. That was actually a comment that came up in my most recent video. Someone said, I'm always talking about the past, I'm showing too much historical data. I believe you can learn a great deal by looking at a company's history, but when it comes down to making a decision to buy, sell, or hold, you want to be looking at the future. And here we've got, because of the growth in the internet and the growth in data storage, et cetera, this company as a specialized REIT looks very, very attractive, expected to grow at 8.5%. That's probably slightly faster than the market. Longer term growth maybe is estimated at 4%. So here you'd want to do your due diligence. But once again, you've got a chance to make double-digit rates of return investing in this REIT with a 6.64% current dividend yield. It does have a lot of debt. It's BB minus rated. Those are, considerations you would have to make. Moving on, I'm going to go ahead and go into information technology. In this case, IBM. Everybody knows IBM, who they are. This is a company that's in transition. People forget this. I remember writing years ago when IBM looked like it does now, and I talked about it being a poor investment. And then what happened was, because the fundamentals didn't look that good, but all of a sudden, since the 2001 recession, IBM went on a tear. It grew earnings at almost 10% per year, as you can see here, by looking at this time frame up through 2014. But then what's happened, and this is what people think about when they think about IBM today, we went through this period of time where earnings growth has fallen. We've seen things like revenues have been on a steady decline for the company, but the company is in transition. It's moving into the cloud. Analysts are forecasting much better future. Again, this comes down to focusing more on the future than the past. If you believe that, I personally have investments in IBM. I've not made any money. I haven't lost a lot of money either, but I've been investing for the yield. I get 6.77% earnings yield and a dividend yield of 4.78%. The current PE is 14, but I do want you to notice that the stock has been improving, going back to, let's say, approximately this time last year. We've had some really nice, nice enhanced performance on IBM from trough to peak here. It's gone up about 22, almost 23% annualizing at 29%. So perhaps this company is turning itself around, but it's got a very good, solid dividend record. I do want you to notice that their average dividend growth rate has been double digit, but in more recent years, it's been single digits. Their payout ratio is reasonable at 45 to 50%. I believe this is an excellent time to be investing in a company like IBM if you believe that this, behemoth is going to be turning itself around. It is A-rated. It's a very high-quality company, obviously. Peter Lynch once quipped, and of course people's attitude has changed, but he said once that, money managers never get fired for recommending IBM. Well, that was true for most of its history. Might not have been so true for the last few years. But I do think things are looking brighter for this company. And again, do your own research and due diligence. And then finally, the last couple of companies I'm going to look at here are the two that I've been asked about to feature. So the next two companies I'm going to talk about are in the life and health insurance. We're going to start with Unum. I did a video about this not too long ago. This company is extremely undervalued in my opinion. You can buy it with a 4% current yield. Notice the payout ratio of this stock is actually very low at about 18 or 19%. Earnings yield is over 17% and the dividend yield is over 4%, but that's primarily a function of the very low valuation. As a result of that low valuation, long-term performance has been abysmal on this stock, including the income. But the point is, as I said earlier, I'm interested in this stock now because it has become so cheap. And if you look at what's happened, since March of last year, this is another example of a stock that's begun to turn itself around. It's actually up 85% in the last year, annualizing at 94%. So if you're going to, if you like this stock, it's BBB rated, which is investment grade, only has 23% long-term debt to capital, has an incredible earnings yield, which is just telling you that you can buy this stock extremely cheap. And the business is, the market looks like it's beginning to recognize that. So here's one you might want to look at. And the next in the life and health insurance, of course, is Prudential. A-rated, 20% debt. Again, financials have been beaten up. If you go back to and this was a question I was asked, and I hope that the subscriber is paying attention or watching this video, because they asked why all these financials have these low valuations. Well, my own thesis on that is because the financial sector really took a beating and is what actually instigated, if you will, the Great Recession of '08, which was primarily related to, aggressive lending practices. And then these companies were participating in these collateralized mortgage obligations. And we all know the story there. And the market hasn't seemed to forgiven them. You'll notice that prior to that, you could buy these stocks, typically traded at 15 multiples. But since the Great Recession, I want you to notice the multiple's been down in the 8 to 10 range on these, financials. And that's where Prudential is today. But it's very, very inexpensive. It has an earnings yield of 11.45%, a solid dividend yield of 5%. And if I look at the company historically from a standpoint of dividend growth, it's grown its dividend even over the last 10 or 12 years or so at over 14% a year. It hasn't performed as well as the market because it's so undervalued, but even then it did produce more dividends. And one of the aspects about investing in these, in good yielding stocks at low valuations is regardless, of whether the stock price, you could have bought the stock, back here, let's say in 2017. All right in the beginning of the year, just to make a point here. And if you'd have held it during, this whole time since 2017, you wouldn't have made a lot of money, okay? From a standpoint of capital appreciation, you'd have been down about 25 or 30%. But what you did do, what would have happened is you'd have seen your income increase each year that you held the stock as it hopefully eventually moves back into fair value territory. So, you're being paid to wait patiently in a case like this. All right, that pretty much covers the first half of the current income selections that I talked about, that I wanted to talk with you about today. And what I'm going to do is I'm going to break this into two videos. I'm going to try something a little different. I'll be curious to get your feedback on it. So I'm going to go ahead and post this video with the first half. And then in the next set, I'm going to be covering 10 additional stocks where I'm going to get into 4 energy stocks, 3 in consumer staples. Then I'm going to end with AT&T and Verizon, which are, a comparison that many of you have asked to look at on the subscriber request series. So go ahead and watch this video at your leisure, and then I'll be posting the second half here also today. Thanks for watching. I appreciate it. If you liked what you saw, don't forget to subscribe, ring the bell, give me a like, do all those nice things. I always appreciate it. And share the message. If you think these videos are valuable, tell your friends and ask them to come and join our subscriber channel here. We appreciate it. Thanks for watching.